It's worse than 2008. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we see a stunning collapse in home buyer demand, so bad it's worse than it was in 2008. And despite that, what I want you to see is how the mainstream media completely ignored this and brushed over it as if nothing happened. Because if the word got out that the housing market was collapsing, it would have dire consequences to the economy. And another place we're seeing an outright collapse is a manufacturing sector in the United States. But in our last story of the day, there might be some hope that the worst may actually be behind us. And for those of you wondering what happened to Seattle Mobile in today's pre-market trading, I've got a link to the SEC disclosure. I'll pin it as a comment and in the description below. How you trade it is up to you. And once we get approval from compliance, you can see how I did. Let's head over to Zero Hedge, where we picked today's story up with the headline, Buyer Cancellation Rate at Top U.S. Home Builder Surpasses 2008 levels. And I want you to see that the mainstream media completely ignored this. I'm going to tell you why in a moment, because here you can see I went to Google News, did a search for home buyer cancellation rate over the last 7 days, and by and large you see only a couple articles talking about it, and there's for good reason why. Because what's going on here is what you're seeing are people who have a bid or offer in on a new home and they're canceling. They're walking away from their deposit in big numbers. Now, if you think about the impact here on the economy, the housing market is a huge part of our economy. It drives so much consumption that is key. So if you see a whole bunch of people walking away from their deposits willingly, what does it tell you? Does it mean that prices are too high? Does it mean financing costs are too high? Well, it could mean all of those things. It could be just their confidence in the economy is weakening. Maybe they see job losses coming and they don't want to be on the hook for a new mortgage. But can you imagine if the word got out about this, if the media picked up this topic, what would happen to all the other people who have deposits on a new home? Might they start thinking, well, wait a minute, what do all of these people know that I don't know? What about the people who are thinking about going and put a deposit on a new home? They might change their mind too. And now all of a sudden you see what could become a domino effect in the housing market as suddenly people start to realize that maybe prices are coming down. But the reason nobody wants to talk about this is because we need to keep housing prices higher. We need people to go buy them because that consumption from the housing market, if you think about it from the builder's perspective, well, they've still got homes they're in process of building. They need to keep those workers working. They need to keep them employed. And when people buy new homes, they go out and furnish them. And we know we've got inventory builds all over the place. But again, you start to think about why this is so important and why the media is ignoring it. Think about what happened in China. And we covered this, maybe a month ago, that people willingly stopped paying on their mortgage because they didn't think their property was going to be completed. And look at what happened there. It nearly brought the banking industry to its knees. And so you start to see the big story here of what's going on is nobody wants to see home prices come down. They want people to overpay for them, because if home prices on builders come down, well, guess what's going to eventually happen to the resale market? And then what's going to happen to people who are making payments on their homes? And if those people start losing their jobs, what did they learn in the great financial crisis? Well, it's okay not to pay, and that would be bad news for the banks. So here we can see what caught our attention in the report was skyrocketing buyer cancellation rate in the fourth quarter. The rate spiked up to 68% from 35% in the third quarter and up from 13% in the fourth quarter of 2021. To put some context to that, 68% cancellation rate surpasses even the darkest days of the 2008 housing crash. So again, you see that the housing market here is set up for nothing but failure. But again, the media doesn't want buyers to know about it because they need these homes sold. We'll talk about that more in a moment. And there's even more new homes coming in 2023 because even as builders have cut back on starts, they're still building nearly 800,000 single homes actively under construction, near the highest level of all time, many of which will hit the market in 2023. And now you start to get to the story that I'm talking about is, could you imagine if all these people pull out from buying homes, all this massive supply hits the market, what's that going to do to the housing market and then the U.S. economy? And believe me, if you don't think the National Association of Realtors knows this, they do. And here you can see the National Association of Home Builders, not realtors, my apologies for that. Well, they're well aware because they can see demand for their product crashing and they don't want the word to get out. Because here you can see U.S. housing starts now start to fall to cap first annual decline since 2009 as construction decreased 1.4% in December, dropped 3% in 2022 as single-family home building slid almost 11% last year. So now builders have a problem. They've got commitments to build homes, they've got homes they're building, and they've got homes they can't sell. And so you can set the stage here for what could be an outright crash in the housing market, and nobody wants to see it happen. So if you don't know this is going on, well, then it's a-okay. Maybe you'll go buy a new home, but if the word got out, again, like what happened in China, you could see a snowball effect of people canceling and potential buyers saying, not yet, I'll wait for prices to come down. Family home building jumped to almost 909,000 annualized rate last month, the most since August. However, for all of last year, about 1 million family houses were started, down 10.6% from 2021, the biggest drop since 2009. So again, we have an inventory problem here in the housing space. Applications to build a proxy for future construction fell 1.6% to an annualized rate of 1.33 million units in December, the fewest since May of 2020, a date we continue to hear about. Things are falling since May of 2020. Permits for construction of one-family homes dropped 6.5% last month, also the lowest since the early months of the pandemic. So again, we're seeing this continued trend now of post-pandemic. The economic data is coming down, the economy is slowing, and why you're seeing, of course, the media not picking up the story is they're afraid of what would happen if the housing market went under a second time. Weakness in the housing industry is spilling over into other areas of the economy as well. As I mentioned, the government's retail sales report on Wednesday showed purchases at furniture and home furnishing outlets dropped a whopping 2.5% in December, the most since the end of 2021. Sales at electronics and appliance merchants fell 5.6% from a year earlier, by far the weakest category. And you start to think about this inventory build. Of course, you know all these stores would love to move this inventory because they've still got more coming. And without the housing market behind it, well, they're going to have a problem. And you can see again the snowball effect if the housing market doesn't turn around. But if people don't know, they'll come back and make offers and try to clear out this inventory. And here we can see that housing starts permits, shown in blue, lead housing starts. We can see permits falling as home builders start to turn direction here and say, maybe we don't need as many homes. We got to clear these out and hopefully not offer big discounts. But one thing that's notable here for those invested in the equity market, that as the housing market tends to slow, the stock market tends to slow down too. And this is an ominous sign suggesting if the housing market doesn't bottom here, perhaps another reason the media is not picking up the story is, look, we need the housing market to turn around so it doesn't blow up the stock market like we've seen in the past. And how does that all translate to retail sales? Well, here you go. What we see here that housing starts as they go down, sure enough, start to lead retail sales lower. And of course, we know that of course retail sales is also a function of the stock market. So here we are in a position where retailers and wholesalers are loaded up with inventory. They need to move that. The housing market becomes critical, but thanks to the Federal Reserve jacking rates up, of course, now they've made the market unaffordable on top of the fact that prices are just too high and wages aren't keeping up. But again, you start to see the big picture here of why the media doesn't want to talk about this, because then, of course, there would be panic and that would lead to a crash in prices. Now, one thing I said I was going to increase the price on was CTA-Timer Pro, but I forgot. So if you're wondering why the market isn't dumping today after 2 days after that big day yesterday, it's real simple. What we should expect to see is the fast algorithms start to sell off a little bit, but it's the slow ones. And there's a lot more money in these slower algorithms that's sitting there. And that's why you're not seeing the market move. I'll leave it at 20 bucks for a few days until I get things caught up. But now let's talk about the manufacturing sector and why it it has a big correlation to what's going on with housing and why we need that to turn around too. The New York manufacturing activity plunged the lowest since May of 2020, that magical date we keep hearing over and over again. The Federal Reserve Bank of New York's General Business Conditions Index decreased nearly 22 points to minus 32.9 this month. A reading below zero indicates contraction. The figure was more than twice as weak as the most pessimistic estimates. Now keep in mind, a contraction of minus 32.9 is staggering. It's huge. It's not off the charts big, but it's pretty darn close to a place you don't want to be. Let me show you. Here you can see the U.S. Empire State Manufacturing Survey for General Business Conditions, and you have to go back to the bottom of the great financial crisis, only the pandemic blowing out these levels to levels we haven't seen before. So this is a place you don't want to be. But here's the other point on this chart that I want you to note, that it could mean perhaps the bottom may be in or very close to it. You have to remember now, the economy came off these really high points from fiscal and monetary stimulus. Now, perhaps, maybe the end of the year, we're actually seeing a bottom. And this is one we can't tell in the data yet because we need a few more months to see. Will these surveys start to rebound higher, or will they continue to go lower? If they head lower, well, the show's over. And here we can see just how much this relates to the housing market. Here you see new privately owned housing units in blue against current business activity for the Federal Reserve Bank of New York district. And what do we notice? The housing market goes down with a lag. The manufacturing sector goes down. So here again, if you're trying to keep people employed, if you're trying to keep the economy going, what you don't want people to do is stop buying homes. And how do you keep that from happening? Don't tell them that everyone else isn't buying a home. At the same time, the survey showed steep declines in the measures of prices paid, which means that validates that inflation is indeed cooling, and received by the state's manufacturers, and received means demand is falling, indicating further softening in inflationary pressures. New orders, a good barometer of future employment, dropped nearly 28 points to minus 31.1, also the lowest level, notably, since May of 2020, and marking the third straight month of contraction. Shipments plunged by a similar amount to the lowest since August, telling us demand is headed down. But despite all that, even employment is holding up as factory employment fell to its weakest level in more than 2 years, indicating that hiring has essentially stalled. And this is a story we keep talking about, that employers are not willing to get rid of people just yet. They're betting the economy is going to bottom and turn around. If it does, then they got it. If it doesn't, then look for the months to come. The layoffs start to increase in a big way. Moreover, an index of the employee work week shrank. There's your validation. Demand is going down. So you keep people on the books, but give them less hours to work, the lowest since August. And despite the weakness in the current indices, forward-looking indicators, improved modestly. So again, the factory sector is telling us that maybe the worst was indeed toward the fourth quarter of last year. Maybe things start to get better. And is there an indication that that could happen? Well, we got one today. U.S. weekly jobless claims unexpectedly fall. And here you can see initial claims drop below the magic 200,000 number that indicates tight labor conditions, fell 15,000 to 190,000, validating that employers are not willing to get rid of too many employees despite the headlines that we're seeing from tech companies. And of course, we know that a lot of those tech workers are able to find jobs elsewhere. And in continuing claims only ticked higher 17,000 to 1.647 million, giving us some indication that indeed perhaps the economy may be actually in a pretty okay place. Not saying stellar, not saying terrible, but the data may show that the fourth quarter was bad and perhaps the rebound is just starting now. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.